Hey, good morning, good afternoon.
Hey, I just bought $200 of Cardano.
You getting into crypto, Sam?
Look, last year I lost more money bidding on Elon Musk, okay? $3,000. $300 is nothing.
Okay.
Oh, by the way, I'm also buying Hong Kong Baba shares. Um I've bought something like 300 400 shares, 450 shares. No more whatchamacallit options, blank call options.
Okay, now move to shares.
Because I think what Alibaba's gonna do is what Ma Bell did in the 80s.
Hmm.
Any
But we
thought?
also know that how Marbell ended. It was broken up.
Yeah. And so people are rich like hell with Verizon, uh, shit Bell, and then what else is there? Sprint. Oh, excuse me. There was Sprint, uh, MCI, and so any thoughts on Alibaba or Ma Bell getting split up in the 80s?
Yeah, Alibaba, I'm okay with Alibaba. I mean, especially it did have not just Alibaba. I think the Chinese government, at least in the last 2 3 months, have shown that they will not uh, kill the big tech industries, which I think a lot of these Chinese entrepreneurs had a concerns going in 2021, 22, right? So they kind of have uh, loosened a screw a little bit on these big conglomerates. And then we also saw Alibaba taking that as a positive signal and also splitting their business. I mean, they announced that they're going to split their business into multiple separate businesses, right? And that could become, markets became bullish on the stock after that because the sum of the parts could be greater than the whole Alibaba, right? So that's where, again, I think when it comes to any company in China, the basic risk still applies, which is the sovereign risk. This year, I have seen Chinese government or the moves that Chinese government has done seem to be more corporate friendly than it was last year. But who knows? Things could change, right? So Chinese economy got, because of the late COVID resurgence, the economy wasn't doing good, and then the government became more business pro, but things could change. So I think that risk is there, but it's okay. I hold Baba in my portfolio, and I think I will continue to hold. If anything, if it works out well, as what indicators that we got based on last few months, that'll be great. If not, it's not that I hold 50% of my positions. That's not even 5% of my overall position. If it doesn't work out, that's fine. So, but it's a great if it was not in China, I would have been a lot more bullish on Alibaba. But this whole big geopolitical factor is a big factor that I can't ignore. So that's my take on Baba. Yeah, again, I mean,
Oh, another thing. I was looking through Serving Monkey, the top 20 largest manufacturing companies, and like um 20 10 to 20 is more or less 15 to 20 is like mainland China companies.
yeah, manufacturing, and I'm not surprised by that. So, anyways, that's on Baba. What else? Any other things that caught your eyes or did new this week? This whole past week was super, super tight for me. I don't know, I think might have been connected to a few on LinkedIn, so might have seen my updates. I joined a new job. And this previous week, my first week in the new job, so it was like drinking through fire hose. Had absolutely, you know, pretty busy in trying to understand new company, how it works. Obviously, I mean, you move into a new company, new industry, new job, and first few weeks, or I would say a few months, are always like this. They're gonna be hellish in trying to understand and find your foothold. So I'm coming up to speed on my new job, and yeah, pretty busy. I know this week was very uh I would say newsworthy in the market, but I may not have caught up with all the news. I spent almost got up around 6:30 today, spent 3 hours in going through okay what I want to present. So hopefully there is some content that you like. But yeah, it's been pretty um, busy week for me. But I'm happy. It's a getting into a new industry that I like, fortunately, and we'll see how it goes. All right. So that's a quick personal update from my side. Okay. So Motley Fool talks about Avalanche also. I don't know what Avalanche are they referring to. I mean, I know Jamie Dimon talked about economic tsunami. So, crypto. All right. So this is the case. I think all Motley Fool, etc. They also have tied up with some of those contractors, and they might be. So these views are coming from those contractors. So even if you read on any of these investment services, always, I mean, you got to do your own due diligence. Avalanche has been called as Ethereum killer, and prior to that, 2021, Solana was an Ethereum killer. Cardano is Ethereum killer. Any new smart contract platform, it starts as an Ethereum killer, right? So, but we don't know which one will eventually be adopted. So far, none of those projects have been able to uh, you know take the or upset Ethereum's position as the dominant smart contract management platform. I also saw, I think there was some news of, was it in India or somewhere, that one of a corporate offering, corporate debt offering was done on Ethereum blockchain. I don't recall which company was that. So more and more, I mean, more projects are coming on Ethereum. The only fame that these Avalanche and Solanas, etc., had against Ethereum, the only positive point that they had was the speed of execution, right? Which may or may not be speed of execution. Number two was these were cheaper. The gas prices were cheaper, but those may or may not stay as the competitive advantage, because after moving to proof of stake, Ethereum has also become faster, and I see more and more L2 or what do you call other projects to make Ethereum faster are coming up, right? L2s like Polygon is there, ZK, a lot of ZK Snark projects are coming up. So my only problem with these avalanches and Solanas are these, we have to find out which are the big VCs behind it. And anytime a VC is involved, big VCs are involved in the project, you will see a lot of market chatter around it, right? VCs pumped up Solana in 2021, especially multi-coin VC. They probably would have invested, and a lot of retail investors would have been holding the bag. I don't know which are the VCs behind Avalanche, which may be pumping the Avalanche now. So you've got to be careful. That's quick thought. I haven't looked at any of these cryptos lately. Yeah, I mean, when I say lately, in last, a month or 2 months. All right, LRCX, I think that is Lam Research jumped and now lower. NVO. What is NVO? Oh, Novo Nordisk Pharma. Okay, this is Europe-based pharma. Um, I have not followed Novo Nordisk. I have no comments on it. But Lam Research, it could be, I think on Friday, at least I saw, Lam Research jumped on earnings. So was the TSMC. It jumped on earnings, but then the outlook was little, at least for we're going to talk about TSMC, so I'll let me not jump the gun, but they also reported that there may be a softness in near term. So I don't know if, and if there's a softness in terms of a chip requirement, so I think LRCX or TSMC or any of those companies in the overall value chain of the chip manufacturing will be impacted. James might contact you, but it is crypto like you do options. Yeah. Cool. All right. So what do we want to talk about today? Today, I do want to talk about, today will spend a lot more time than usual on going on some of the macro stuff. I found some good information today morning, so I thought I'll share that with you. Then we'll look at the earnings for TSMC and Tesla, and then also want to share some of my notes on Airbnb. Okay, and as usual, we'll talk about a few more stuff. So that's on my agenda. Anything else if you want to add, put it in the chat. I'll be, we'll continue to monitor the chat. All right, with that, let's get going. So, okay, let's start with our thought first. It is more important to be sane than smart to make money in the stock market. I don't know whether it came from, which nanogenarians, whether it was Warren Buffett or Charlie Munger, but one of them had said it, and I think this cannot be more evident than what's happening in today's market, right? If you look at today's market, you don't know, one week it's up, other week it is down, mostly moving sideways. It could make us insane trying to figure out the direction of the market and try to trade accordingly, right? And it's I think our long term, again, making money in the market is, even if we pick up just basic ETFs and go with it, we don't have to use our heads, we don't have to use our brains, we don't need Ivy League degrees, we don't even need economics degree or a CFA charter. I mean, we don't have any one of those. We could still be invested in the market only if we can go through these whole insane moments that we have seen in 2022 and the whole volatility. So couldn't agree more that when we start in the market, and I'm also guilty of that, everyone goes through the same process, right? You start in the market and we try to consume too much, try to think that we need to understand all the nuances of how market works, how stock moves, look at 10 different technical indicators, try to understand all your financial ratios, without focusing on the behavioral part. But over long term, I think that's the behavioral part is way more important than what we learn from technicals or from fundamentals. All right, so macro. So from a macro perspective, it's been 6 months now since October low. Right? We in the recent, that was alone. After that, markets generally have been in uptrend, even though we have all those volatile weeks. But from October to now, if we look at the why, so this was the last October, And although there has been a lot of volatility up and down, but it's been 6 months and the market has come from almost 350 to now 410. So it's been a pretty nice recovery since October. It was below 3,600. Core inflation had accelerated to 40-year of high at 6.6%, and 10 years was yielding 4.25%, right? Since then, markets have recovered. Both your stock as well as the bond market has recovered. So let's find out a little more details around these, bigger categories. What's happened in the economy? What's working? What may not be working over the past 6 months? What's happening under the inflation, Fed policy, corporate profits, and what the market indicators are telling us. Right? So let's dive into it. So economy side, what has worked in last 6 months? What have been the tailwinds? Right? Economic activity has held up better than feared, I would say. Still it is in expansion mode. It has not entered into recession yet. After adjusting for inflation, US GDP actually grew 2.6% in the fourth quarter of 2022. And the current estimates from the Atlanta Fed is that we'll probably have 2.5% of growth. So when it comes to economy, it has grown nicely, right? 2.5% growth for US is better, of course, in China and in other emerging economies or developing countries. This is not a good growth, but for US, pretty decent growth. The source of the strength for the job, the economy has been the strong job market. We have heard Fed talking about the strong job market multiple times. Job gains have slowed, but they are still positive, right? There are still jobs have been added. Of course, the pace of that addition has come down, but still it's positive. Unemployment rate is still low, even with the rising participation, as more workers have joined the labor force, but still the unemployment rate is low. What is not working is some of these things are about to cool. Right? Jobless claims have remained low, but have been now started to rise. Right? Opening is starting to come down. Layoff announcements have been happening. It's no secret in the tech industry. I think the one stat I was looking was 175,000 jobs have or 175,000 workers have been laid off in the tech industry. Right? Temporary help payrolls are off their highs. The leading economic index, which has got 10 different indicators, they all tell that there are downside risks which are ahead for the economy. So while the six months have been better, looking forward, the leading economic indicators tell that situation is not going to be same as the past 6 months. Right? Credit have tightened. Bank have their cost of operations are going high, so they have not stopped, but they are also restricting the whole lending. So what 10 LEIs we are looking at? So let's look at the leading economic indicators. So this is from a conference board page. These are the leading economic indicators, right? So only one of them was positive, which is manufactured new orders. All of them at the end of March are, showing a negative. So, and if we use all these economic indicators and plot one graph for LEI, it is below red, which kind of a signal that there is a recession coming. And that is why Fed is expecting recession to set in at near the end of the year. Right? So from an LEI perspective, right? So these are the indicators which look forward. Right? And I think I have a list of all those indicators, so we'll get into that. But these are the indicators that look forward. And if you look at these indicators, they do indicate that even though the last 2 quarters we grew by 2.5%, going forward we may actually contract, right? So yeah, so these are the 10 leading economic indicators. One is work week in manufacturing, building permits, jobless claims, consumer expectations, consumer good orders, S&P price, SPX, basically, ISM, supply, new orders index, credit index, how much is credit in the market, non-defense capital goods, and interest rate spread. So you combine all of these, the indication is, guys, we probably may end up in recession, right? So these black bars are the warning signals, red ones become your recession signals. So this is what's not working. What's the path ahead? What may happen? What's most likely? No one would know it. If it's going to be hard landing, are we going to do deep recession? Or it's going to be soft landing and mild recession? Or it's going to be no landing and maybe just sideways swings? If you look at the most market participants, I think the thinking is probably it's going to be a soft landing and a mild recession. We may not get into deep recession or a depression a phase in the markets, but probably there will be some mild recession due to all this increase in the interest rates, tightening in the lending conditions, and all these economic indicators. That's what they're portraying. What will happen, we don't know. But right now, this is at a macro level. This is what our economy is telling us. All these charts are telling us. Next, let's talk about inflation and Fed policy. What had been working is aggressive Fed tightening and the high inflation. Those were the headwinds. Sharp rise in interest rates have pushed the valuation lower. That we all know. We look at the SaaS valuations from 40x for high growth companies. Now it has come down to 6x multiple. So valuations have all come low. Core inflation had peaked 6 months ago. And that's where in October stocks also bottomed out. We have a benefit of lower energy prices. So last week we looked at CPI numbers and energy was down 13%, one of the biggest contributor to the inflation. Housing is still is the biggest contributor, but last month's shelter cost had their smallest increase. Stress in the regional banks. We don't have to talk again. Silicon Valley Bank and Signature Bank and First Republic. Those have been all across the news. But the drop in 2S treasury yields below the Fed funds rate generally show that, hey, the Fed is becoming over restrictive. And we have seen that happening. Now with this disinflation, means inflation still there, but increasing at a smaller pace, disinflation and Fed tightening, maybe in the future, we may see that Fed may not hike as much as what they thought earlier. And we talked about it, in previous session also, right? Investors are the consensus among the investors and the market is one more rate hike in May. There is a saying, right? Sell in May and go away. So I don't know if this year, if that's gonna prove right, because looks like May is the where at least this is what market is anticipating, that May will be the last hike. After that, probably no more hike for a few months, and bond market is pricing 2 rate cuts by the end of the year. But Fed is saying no more rate cuts. We will be data dependent, and maybe by that time, all the impact of the tightening that has happened so far will start to flow into the economy, and Fed might do a rate cut by the end of the year. If that's the case, it's going to be bullish for the markets. So I don't know. In May, we'll see what Fed does in May. But so far, Fed is dependent on data, which is generally lagging by a few months, because all these uh, the impact of increase in the Fed funds rate will start to show up economy not immediately, right? So now what Fed fund rate is 4.75, its impact will start to show up in a few months. So by that time, if economy or if the situation become from economy perspective, situation become bad, then the Fed don't have to do the job of bringing down the inflation. So maybe then they'll start to pivot. Anyway, likely path could be market is expecting rate hikes after the policy rate reaches 5%. That will be an important step for sustainable recovery, and the yields, etc., on the bonds and the notes and the bills probably have also peaked. So we should see all those coming down. So that's on the inflation. And on the Fed side, let's look at the corporate profits. So we are in Q1, earnings season has already started. We had banks already reported results. This week is going to be the coming week is going to be the big week, wherein a lot of tech companies are going to report their results. But from a bank's perspective, they were better than feared results, right? I would say it was a mixed bag. JPMC did really well. I think the regional banks were not that great, but the banks are still there. They are still surviving. They haven't died. And even though the financial services sector has been and the worst performer for the year, but the stocks have outperformed the rest of the general stock market over the last 1 week. Right? Revenue growth for S&P 500 is continued to be positive. There will be growth, even though the growth is little less. Several airlines are seeing strong demand for travel. US dollar has declined 10%. So all these multinational companies that have operations abroad will on their books, the decline of US dollar will anyway pump up their numbers. What's not working is we already have had a very strong performance in the tech sector. It means our expectations are already elevated. And if the results are not perfect, we might see market selling off. So QQQ is up, what, 90, almost 20%. We look at QQQ, YTD change is 19.71%. This is what we are in month of April, right? So the other big shares, Meta is up 71% for the year. Apple is up 32%. Let's pick a few more. Google, Google is up 20%. So a lot of this tech sector has already recovered in the hope that so those expectations are already elevated. And if this quarter we don't see near perfect results, that's going to be a headwind for the market. Another thing that we already discussed in some of previous sessions is the forward earnings have been being revised downwards. So far, we have declined, already revised 7.5%. It means almost no earning growth for S&P 500 this year. So those are the headwinds. Likely path, maybe a more downside risk. Valuation, but valuation tend to bottom out before the earnings do. That we have seen before the recession set in. market has already bottomed out a few months ago. So who knows, even if what could happen in a month. But right now, I'm little concerned about the tech sector. 20% high in such a quick 3 months in one quarter is way too big. But it is coming off from one of the worst years in past 2 decades. So who knows what's possible. Looking at market indicators, despite a long list of issues, recession, inflation, debts, and geopolitical concerns, VIX is still low, volatility is still low, which is what's surprising is vol is around like 16%. And over almost for a month, it's been consistently coming down and hit a 52-week low of 16%. Right now, the market is already kind of assume nothing big, no, I would say that everything looks to be okay, but that may not be the case. Right? So this is really surprising given the fact that we have so much of uncertainty around debt ceiling, recession, that the VIX is still at 16. See a question, can you describe what or how VIX operates? So the VIX is calculated based on the options, the put and the call options on the SPX index for the next 30 days. So if there are more put options that are being bought on SPX, that elevates the VIX, so it's based on what the option market tells us. So this basically tells us for next 30 days, market is expecting the very less moment on the SPX. The downside risk on SPX is less. So that's how the VIX is calculated using the options data on SPX. Okay. So VIX is low, which generally for me, that is being a contrarian. For me, that would be that if any one big bad news come out of the market, the earnings earnings don't are not as good as what the valuations are suggesting it to be, then we should see a big uptake in the VIX, right? Right now, the VIX is at where generally it is 15 to 18. 16 is a normal 50, yeah, I think between 15 to 20 is a normal VIX period, right? When the markets are hunky-dory, things are fine, not too bullish, not too bearish. But this market doesn't seem to be like that. So rise in corporate credit spread has been contained. It means the risk of the defaults have come down. While the sentiment has improved over the past 6 months, still bearish. The amount of cash that they're holding is elevated. This year, all the rally that we are seeing is very, very narrow, concentrated in these mega tech caps. So since Jan 2005, if you look at the S&P breadth, right now this is lowest since 2005. Very few stocks are having the most impact on the market, and those stocks are the big mega cap stocks, and most of them are concentrated in the tech sector. That is why we see that the QQQ is up 20%, while the rest of the SPY or the SPX index is up 7 to 8%. Okay, so could be likely path could be, it may not be a V-shaped recovery, but maybe a U-shaped recovery, right? So you may not see a huge recovery in the markets pretty quick. We may go towards sideways before we have, move into a recovery session. So it's going to be a prolonged recovery, not like a COVID one. So that's on a quick uptick. I know this is a little longer than our usual, but I found this pretty interesting. It was, the overall information was much bigger. So I had to summarize and bullet point it to make it, little more consumable, if I may. Otherwise, it will, to me, a lot of this stuff could just put me to sleep. Gold. What happened to gold? Gold peaked at what, 2063. Gold futures now they are below 2000. But we'll see. Anyway, gold have had some great run over the past. Again, this I believe is November, December. Over the past 4 months, it's been from close to 1600 is now close to 2000. So pretty decent run on gold. Maybe some profit taking might be happening, but we'll see. Too soon to conclude anything. Crypto side, last week we saw a lot of weakness on the crypto side as well. Bitcoin, last week when we looked at crypto, Bitcoin was above 30K. Now it's back down to, as of today morning, it's down to 27.5, down 10%. So is Ethereum. The way Bitcoin, Ethereum goes, so goes the rest of the crypto market. And year to date changes are, yep, S&P up almost 7.5%. NASDAQ index is up 16 or 15%. Pretty big moves. And if you look at the top 100, which is QQQ, that is up almost 20%. So we already got the long-term average gains in the S&P index in first 3 months. So I'm a little cautious, continue to try to reduce our deltas in the portfolio, and keep fingers crossed. Hope is not a strategy, but we don't know how the market might operate. If Fed is gonna pivot, or we'll see on May what Fed does, and if the Fed still indicate that they're gonna increase after May, then we might see some sell-off in the market, because the current expectations are no more rate hikes after May. And if Fed doesn't deliver on that expectation, so far Fed has been delivering, right? So sometimes it feels like market demands, and that's what Fed does. But if that's not the case, after May, we might see divergence and market might sell off. But we'll deal with it when that day comes. I hear one-day VIX is coming out next week. Ooh. That, I mean, it will be, you could always calculate VIX. And now I think the one-day VIX may be coming, because now we have those daily SPX options being traded in the market, right? And that's doing some crazy shit in the whole options market. I think maybe, and I don't recall if this is true or not, but did we hit 1 billion option contract in a month already? Billion option contracts in month. Let's, no, not 22, 23. Yeah. So I think we're looking at, maybe because of all these 0 DTE options, or this we already read, we probably hit 1 billion option contracts in a month. There is also a chatter in the market that it may not be out of the realms of possibility that we may see 0-day options for stuff like Tesla and Apple, these most heavily traded single stocks. So right now, these 0-day options exist in SPX, but SPX is a very big instrument, and not everyone can trade on SPX. But I guess if it is a 0-day, then you could. because you don't have to hold big margin anyway. But in any case, a lot of folks are more interested in trading individual stocks. So Tesla generally is the most tradable individual stock on the stock exchanges, right? From a volume perspective, average how many contracts are traded? Tesla is generally number one, or Tesla and Apple always trade places between number one and number two. So I'm sure exchanges are, salivating on the prospect of adding zero DTE option contracts for these heavily and loved tickers like Apple and Tesla. Jess is day traders lose 358K day on a zero day. That's fine, but exchanges make money, right? So when exchanges are trying to introduce the products, they're not thinking whether those day traders who are trading this, they make money or not. But exchanges will make money if you trade, whether you have made or not. That's a different one. So there's a lot of a gamma risk in zero DTE. So I don't touch these because I can't. You have to really, really closely monitor position minute by minute and have to be very nimble. And even then, you end up losing tons of money. But on the cost of those day traders, exchanges make a lot of money, and they will not let any opportunity go by if they can find ways to make money. So I'm sure these exchanges, they might be petitioning OIC, these market regulators to enable them to list daily options. And then, more avenues for exchanges and market makers to make money. Different thing is, a lot of retail investors will end up losing that money. But you get a lot of, sugar rush. There is a reason why Vegas Strip exists, right? And it's at the end, it's a casino that ends up making money, but a lot of, but still, it's the strip is there and is always crowded. Same will be the case with zero DTE. All right, since we talked about earnings, let's quickly look at which are the this week is going to be a big tech week earning. All the biggies are reporting earnings. Microsoft, Alphabet, Meta, Amazon, I don't know, Snap is not a biggie, but for whatever reason, Snap results are always discussed, get a lot more airtime than what I think they should. Who knows? But that's the case. And Pinterest. So let's look at so far, because of the increase or the recovery that we have seen in the stock market, especially in the tech markets, a lot of these tech companies, their multiples have already increased by a lot from where they were at the start of 2023 to where they are now. So right now, many of these big tech stocks are trading at much higher multiple than they were at the start of the year. And now at the end of this quarter, if you don't get near perfect results, these multiples may shrink. Right? S&P weekly performance, I think this was weekly. Overall, at a week basis, it was lackluster. Nothing much has changed at a week to week basis. It was like, we can just ignore it, 1/10%, right? Pretty much sideways movement if you look at the overall week. What else? A quick look at the world market. So gold has trumped Apple to be, gold was always bigger than Apple. From a individual stock perspective, Apple is still the top. Aramco is number 3. Silver is at number 5. Tesla used to be at the top, but based on after their earnings, the little bit beating that Tesla got, it actually slipped below Meta platforms. So that's it below. And 11th is Bitcoin, 12th is Tesla. That's all the overall macro side. Any other things that you noticed or you want to talk about? We can Google it.
Some guy, some famous billionaire is really negative on Tesla.
Really? What? Sorry, miss it.
Sorry about that. Some
Lost you. You're mute. Sam, you're mute. Okay, what is the website for the market caps on your page? I believe you're referring to this one. Jay, this is, I think, 8. Hold on, let me just. It starts with number 8. Yeah, 8marketcap.com. Oh, sorry, infinite. Yeah, so it's basically infinitemarketcap.com. Starts with the symbol 8. Let me check if you're okay. Oh, Auntie Kathy Wood, she's loving Tesla. Yeah, what her price target is was 2000 for Tesla. Right now, Tesla is at 160 or something. 165. So from 165 to 2000, that's where her price target is in what, 5 years? I think it's end of 2027 or 2020. Yeah, 2027. So end of, yeah, almost 5 years. That's going to be a pretty great return. But she's also talking her books. So, I mean, ARKK or Tesla, it does have a, I mean, I don't have Tesla, but I'm building my positions on ARKK, and that will give me the overall exposure that I need to have to these, many big Cathy Wood favorite stocks. Her bear case is 700. All right, so we will talk about Tesla a little more as we go along, because Tesla also reported earnings. But until then, again, in spirit of transparency, what bought and sell in my own portfolio, nothing that I wanted to do it, but some of my option trades, I took assignment on. This is Chinese EV. They're doing some good work on flying taxis as well. But after Tesla cut the prices, all the Chinese EV makers stocks were impacted. A little bit, a few shares sold on Malay because my call spread was in the money. So this is something which I started doing this year, is to, I mean, I didn't do it in 2021, 22, should have done there, but everyone learns from the mistake. Is if market or the stock has gone, at least this year, what I've done is, if a stock is challenged and is my call spread, I have to take a loss on my option trade on the call spread side. I will sell a small amount of share just to sponsor that loss. Now, what I didn't do in my previous years is I would close that call spread for a loss, right? And then put another one, and then one find the stock. You don't know what the markets will do. So when the market will come tumbling down, I still hold a big portion of my long stock positions, and I will try to put a short put spread, because the market was going higher, then that'll be in the money. So this time I thought, hey, just to neutralize, make sure I don't go too big on my deltas. So if I'm closing my call spread, I'll take off some equivalent delta by selling the shares. And Then I go ahead and put another one for a longer duration, higher strike price, iron condor, so that if stock falls down, I'll be able to buy back those shares which I sold. If the stock continue to go higher and now challenge another call spread, that's great. That's a good problem to have, right? So you see this Melai, Meta, XLV are all because I close those call spreads. It's a call spread is probably is a one part of an overall trade. In Melai, Meta, those are iron condors. In XLV, that was unbalanced iron fly, in which the call side was being challenged. So I closed that, sold a couple of shares here and there just to sponsor that, and have put another one. If stock falls down, we'll be able to pick up those shares again, right? SLV, again, I had a call assigned, shares got called away, and I already have my short put at the same strike price for next expiration period. So these were the stock movements from last week. Okay, I see another 5 stocks receiving downgrade from analysts. Number one, Tesla. So did the downgrade came before Tesla earnings or after Tesla earnings? I'm a little skeptical of many of these analysts, especially the sell side analysts, because many of them, they will just follow the price. And it looks like HSBC did the same thing. They threw in the towel with NVIDIA. It came in today. Then it's fine. Then I don't know if they really did their homework, or probably they're just following the price. All right. I do want to address one of the open question from a previous session. I think was it Bobby or Jay, someone had asked for it, was around correlation. So I think the question was, where can you find the correlation? So I want to spend a couple of minutes on what is a correlation, why is this important for us as an investor. So net correlation is a strength. It is a measure of the strength and the direction, right? How of the 2 tickers that we hold in our portfolio. So when I say strength, it is measured as between 0 to 1 or 0 to -1. So if a value of a correlation between 2 tickers is 1, it means both the prices of those 2 tickers move in tandem to each other. If XYZ is going higher, then ABC will also go higher, almost at the same magnitude. If XYZ is up 10% and its ABC is correlated with 1, you might see ABC also moving up by 10%. Okay, so it tells us the direction, which is positive, means both move in the same direction, and the amount, the number tells you how strong the correlation is. If it is a negative correlation, then it means they move in the opposite directions. Generally, stocks and bonds are supposed to be negative correlated. It means if the stocks are going higher, bonds will go lower. So why it is important in investing is, if you want to diversify our portfolio, we generally say, hold 15 tickers in your portfolio, right? Hold 20 tickers in your portfolio. But what if those 20 tickers, half of them are, Airbnb, Pinterest, Snap, Google, Microsoft, Amazon, IBM, all the tech stocks, then it is not really diversified portfolio, because the correlation of all this is very strong. So how do you find correlation? These are the couple of sites that I used. One is ETFs, right? So I hold big, build a lot of positions on ETFs. So you can actually put a ETFs over here and find its correlation, right? So if I want to find correlation between, let's say you want to hold 5 or 6 ETFs in your overall portfolio. Now, which one you should pick up? is you can actually check the correlations between them using this website. You can say, okay, I want to hold XLV, XLU, SPY, QQQ. Let's do only 4. XLE, energy. So if you look at this, and if your majority of your portfolio is SPY, then XLE and SPY have only 0.53 correlation, right? So looking at this could give you some idea of, are you holding a very concentrated portfolio or not? Now, if you have individual stocks, this is another website. Oops, come on, open up, where you can give the ticker symbols and say you want to look at a correlation between these period, right? The previous one, this goes back 126 days, which is, I guess, that is 3 months to look at the correlation, because there is no point in going back too far back in history, because things change, markets change, ETF composition changes. So you could, here you could actually define, how you want to look at the correlation. You want to look at daily returns, pick up your symbols. Let's pick up QQQ, SPY, and want to look at last 3 months. Let's say start of this year till the end of March, and daily returns, and we're looking for 30-day correlation, rolling 30-day, right? So no wonder all 93% very, very strongly correlated, because majority of the gains in SPY is coming from those big tech companies, which is also driving the gains for QQQ, right? You want to add few more, want to look at, let's say, J and J. That's not correlated. So it might make sense to hold some of these tickers which are not strongly correlated, right? Now, at one area where this correlation goes for a toss is those outlier moves that we see in the market, right? Outlier moves like what we saw in March 2020. Okay? Those extreme cases, then everything is thrown all together, whether it is utilities, whether it is tech stock, whether it is anything, because then nothing in the people become so scared that they all dump anything that they hold in the stock market and move to cash, right? So that's one area where I have seen multiple times that the correlation will break, but those incidents, thankfully, are far and fewer. So generally, these things will work fine. Make sure when you're building your portfolio, maybe if you have 10 tickers in your portfolio, put those 10 tickers here and see what the correlation is. If all of them are very tightly correlated, then you really don't have diversification, even if you are holding 10 tickers in your portfolio. So that's where correlation will make sense. Cool. All right, let's move on. And something that caught my eye was, I was so dismayed or disappointed that being a prudent financial manager doesn't reward you anymore. I don't know how far this is true. This is, I saw in Twitter, on Twitter University. So I don't know, is this a doctored one or not? But looks like if you have a lower FICO score, you get a bigger fee discount. If you have a higher FICO score, you pay actually 1% fee. So you are being punished. There's a moral hazard in this. I don't know what signal are we sending to people that if you behave well, this is a punishment for behaving well, that you're basically sponsoring those who haven't been doing a good job of managing their credit score. Yeah, you are paying the fee, and those with a lower credit score are getting a discount. So I don't like it, but I don't control it. But I, yeah. So anyway, I hope this is not true, but pretty bad. Tesla. Tesla cut US prices for the sixth time this year. And this one was pretty quick because they did one price cut last week. They did another price cut this week, again, to juice the demand. And this came in right before their earnings announcement, right? So they also had lowered in Europe, Israel, Singapore, Japan, Australia, South Korea, again, to of course, started with China because they want to capture more and more market share. They've been losing market share to BYD specifically. That's one of the biggest competitor of China. So far in US, Tesla is still the largest EV seller, though the overall share has come down from more than 75% to I think it's now close to 60%. But worldwide, it has worldwide BYD has grown from 5% share to almost 20% share of the vehicle markets. So that is also putting pressure on Tesla to reduce the prices, because these BYD cars are way cheaper, or cheaper. I don't know the numbers. I shouldn't say they are way cheaper, but those are cheaper than the Teslas. And given the recessions and and the tightening in the spending that's happening, people may not buy that much of a Tesla. So Tesla is now at 12% of the uh, overall EV market. US side, another chart is the different models. So Tesla Model Y from 33% to 30%, Model 3 from 30% to now 19%, whereas Volkswagen Model X has increased, Mercedes have increased by a little bit, Chevy Bolt has taken a lot of lead, and Ford F-Series has taken a lot of leads as well. So BYD sold over 1.8 million units of EV in 2022, which was 153%, with 153% growth in Q4. Tesla is now number 2. It is now 1.3 million deliveries in 2022. So coming to earnings, revenue was up, slightly beat. EPS was in line. Outlook is 1.8 million deliveries, which is still 50% growth is what Tesla has committed. That's what they're still committing to. Productions was up 44%. Deliveries were up 36%. So they now this. So I've always heard Elon talking about that they had a production problem, not the demand problem. But I don't know. This time the production had increased by a lot, but the deliveries didn't happen. If deliveries didn't happen, is it because the demand wasn't there, or the deliveries didn't happen because, hey, the demand wasn't there, demand was there, but we were not able to deliver the car, which I don't think may be a case. So I do see some dichotomy between the statement saying, hey, we have a insatiable demand, infinite demand for our cars, may not be exactly true. Elon did say that they are seeing a lot of headwinds because of foreign exchange, high interest rate, etc. Margins came under pressure. Of course, if you reduce your prices of the cars, the margin will come into pressure. But operating margin was like 800 basis points down because of the increase in interest rate and increase in the prices of raw materials, etc. So now their operating margin are down from high, almost close to 20%. Now they are down to almost 11%. And the free cash flow also dropped 80% to 441 million. So stock was down after earnings. It was down almost 10%. Market doesn't like that your margins have come down, because that was a big story, is Tesla's margins are like software margins. Now if the margins are being impacted, then their valuation should also be like an, should not be like a software company. So I guess that's where the concerns have come from. During Q&A, Musk mentioned that he foresee a 12-month of stormy weather in the economy. Every time the Fed raises interest rates, that is equivalent to an increase in the price of a car. And whenever there's an uncertainty, people will generally postpone big new capital purchases like a new car. Right? So that may be a reason why the demand may be softening, and the reason that Fed is raising the interest rates, that is also hurting on their margins. So we have taken a view that pushing for higher volumes of the larger fleet is the right choice. So we want to increase the number of cars that we want to sell and to attract those buyers. So if there was infinite demand, you may not have to do it. But in any case, to attract those buyers, you have to reduce the prices. So we are seeing 6th price cut in Tesla. And Tesla vehicles over time will be able to generate significant profit through autonomy, which at least I read it as a BS. The whole case of autonomy, because I saw another interesting chart is the Tesla FSD capabilities. And I didn't know about it, but it's right over all the way at the bottom in terms of how good its autonomous driving capabilities are. In US, we only hear about Tesla, and if you look at the tech of Tesla, when it comes to full FSD, they are way behind a lot of other players in the market. Couple of comments. So I use Fidelity to check asset correlation, but we'll use these two. Okay, that's fine. At least I'm good that this is useful to you. If you have good score, you will subsidize low credit person mortgage. That's exactly what I'm saying. Why? It's like you are dragging down someone who's running fast and putting more burden. Okay, now you carry other people on your back if you're running a race, right? I don't know. I don't get it. There is a moral hazard. Then why should I behave in a more prudent manner if I'm being penalized for that behavior? Says typically these charts include plug-in hybrids, especially for BYD, not pure EVs. Okay, you're talking plug-in hybrid like Toyotas and the BYDs have. I'll have to go back and check. You may be right. 9% of the 10% drop came because of the last statement on autonomy. Yeah. Moved recently to SF, and I see at least 3-4 Waymo and Cruise autonomous cars with no one roaming around every day. Yeah, so I think this Cruise is the only one who have received approval. Maybe Waymo also did, but we did cover when Cruise got the approval. The Cruise was the only company that had gotten approval to do 100% full autonomous rides in San Francisco and charge for it. Earlier, Cruise used to do it only when they were not allowed to charge the customers, because that was on a trial basis, and they were also restricted for a particular time window that you can only operate when there was a less traffic. Now I don't recall it. It's been a few months, but Cruise was the first one to get that approval, and Tesla was no longer close to it, right? So now this chart actually shows the right thing. Waymo is not offering rides. Yeah, so again, I think the Waymo probably is still in the process where Cruise was a few months ago, where they were still doing rides, but there were still driverless cars, but those were not rides. They were not allowed to charge customers. But now Cruise can actually charge customers. All right. When Tesla began discussing its ambitions on self-driving tech in 2017, we were supposed to get a hands-free trip by end of 2016. We were supposed to get a hands-free trip by 2017. A million robo taxis by end of 2020. It didn't happen. Silver lining on the Tesla results is their energy business was up 148%. But it's a very small portion of overall revenue. But focused on two areas of energy. One is home backup battery, the power wall, and the other one is for big utility companies to store energy. Utility companies mostly focus on the renewable energies, right? Sun doesn't shine 24/7, and in some cases it doesn't shine even for an hour in 24 hours. So you need those companies will need a way to store that electricity, store the energy. So that's another mega pack system which Tesla has. But at least these energy business this quarter has done really well. That's the only silver lining I could see in Tesla's earnings. So breakup is this: sales up 21%, other services up, energy storage up 148%, overall revenues up 24%, in line. Problem is the gross profit is down 17%. Your net income is down almost a quarter, 25%, which is a huge, I would say, drag on the profitability and also on the stock. The whole game was that, hey, you can run your business like with the huge margins. Now those margins are under pressure. Yeah, so pressure on margin, that's not working. Reduction of the market share, concerns on delay in rolling out new models. I heard that now the deliveries, the pilot deliveries will start in end of 2023. And I don't know when the full production will. There are generally tall promises, but they fall on delivering of the promises as well. What does work for Tesla? They have a first mover advantage and they are the top dog, premium brand and strong affinity, right? You can love Tesla or hate Tesla, but you can't ignore Tesla. They have a higher margins still. Even after this contraction, their margins are still better than the other automakers. So when Tesla is cutting prices, you saw GM, Ford, NIO, other stocks that I hold, they all fell down because now they all will face the similar margin pressures. Or if they don't cut down the prices, then they may lose the market share. So they still have better margins than the traditional automakers. For example, Tesla generate 12.6 billion, whereas the BYD, it generated only $2.4 billion in profit. So it's still a big profit-making machine. But the concern is, hey, the valuations were way higher, probably had assumed a lot more profit margins than what currently Tesla is offering. So if you compare it with other automakers, great margins, compared with the software, that's where the story starts to break. That's on Tesla. And just when I thought, okay, I am opening up to buy a Tesla vehicle, not the stock. Yesterday I was discussing with family, should we look at Model Y? And both my wife and my kids says, no, we should pick up either Audi or Benz. I'm like, what? Now the Model Ys have become cheaper. And now they have flipped. So I'll see which one we probably end up in. I don't even know why we should. For me, I'll probably buy a RAV4. I love those Toyota brands. We don't have much use of car anyway nowadays. So it's only required when you go for long drive with the families, or traveling outside the city, you need SUV, but we'll see. How much margin drop can be reasonable considering 6% auto loans? I think the auto loans are now what, 8%. So I want an analysis of how long will Tesla have to drop to continue before they start losing, to stem the loss of their market shares. Probably some analysts might have done this. I haven't just caught up with it. But auto loans are now 8%. That's what I heard. The general average, it is now 8%. So that does put pressure on all these expensive cars. I'll find out more if, once I go and start looking for it. So, all right. So comparing the profits, still a leading profit car maker, profitable car maker by all means for other EVs. And these companies like Fisker, Lucid, Rivian, I guess these are the ones which will just go bankrupt or out of a business by this impact of these price cuts from Tesla. They are already bleeding money. I don't know how long can they continue to bleed money. So that's the whole on Tesla. Let's jump into the other one, which is Taiwan Semiconductor, TSM. So bigger statement. This is what, if we go through this, everything else is okay. Our first quarter business was impacted by weakening macroeconomic conditions and softening end market demand, which led customers to adjust their demand accordingly. Moving into second quarter, we expect our business to continue to be impacted by customers' further inventory adjustment. So net first quarter, so first half is going to be soft for TSM. That's what the TSM came and told, that this whole first half of 2023, our revenue probably will be softer. We may have a decline in revenue, which is what they had. And we might recover back or get back to our normal business maybe in second half, right? So Q1 revenue was 16.72 billion, which is down almost 5% year over year. Margins were okay. EPS, they beat. Q2 guidance they gave is 15.2 to 16 billion, which miss analyst expectations. So they beat on the stock. Stock was down. Not after the earnings. After earnings, stock was up, but at the next day, then we saw softness in the market, and the stock was down almost from 87 to 82, 5%. So overall, if you look at this chart, which tells us how much revenue do they derive from each type of chip, they're looking at the advanced chips, which is 7 nanometer or smaller. More than 50% of revenue is coming from their advanced chips. And when you look at a platform, only one which is positive quarter on quarter is automotive. All others are low. So smartphone, now this means smartphone chips were down 27%. That might say us something for what we may expect from Apple and Samsung. High performance computing is overall 44%, but it was down 14% this quarter. Only sector which was up in buying chips from a TSMC perspective was automotive. Right. CapEx, they're still targeting $32 to $36 billion CapEx for building those factories in US. Expect weak first half, strong second half. Inventory correction is taking a little longer. AI is a positive trend. You need a lot of chips to do a lot of data crunching, and all these mania that we are seeing in AI or AI stocks or AI in general, chat GPT will be good for the companies like TSMC and ASMLs. Also, they're looking at international expansion. That's where most of the capex is going. What didn't work is a geopolitical risk. So the drop that we saw was again based on Friday, was based on some geopolitical statement by Janet Yellen on something around China. So we still see, unless TSMC has enough capacity outside of China, that geopolitical risk will always be there. Investment in semiconductor is cyclical, because you have to invest 30-40 billion dollars. That will take what time, then that will bring a lot of capacity in the market. And that's why we see then you will see a lot of a glut of chips in the market, and that inventory takes time to consume, and then we'll see another uh, you know another round of investments 5-10 years down the line, when the overall demand exceeds that glut. So generally it is in a cyclical, and right now TSM is doing all these investments. What's working for them is EU chips. The equivalent of chips act was passed in EU this week, which is $47 billion worth of you know I think it was 43 EU or what, 44, depending on exchange rate. The dollar rate, US dollar rate, is $47 billion a package. Yeah, it's 43 billion euro, $47 billion a package. Where that money can be spent? Building large scale capacity and innovation to make sure EU is self-sufficient, prepare the EU for future supply crisis. Right? Chips have become strategic to the future for every country, and now US is trying to build self-sufficiency. So how can you be left behind? They are trying to build self-sufficiency in the chip space. This is like an arms race that we had seen during the Cold War. Every country trying to get and build up their arsenal of nuclear warheads and other missiles. The companies that you want to invest in are the companies that make those missiles. So in this, I think over long term, TSMC should benefit it. Of course, in this particular quarter, there were headwinds around it because of softening of demand. But the way, if you look at it across the world, every big country in EU is a whole consortium of many countries. If they want to be self-sufficient on the chip production, then there are only few companies that currently we have, and all of them will benefit. Setting up plants over there, so on a short term, they may have to make more investments, but on a long term, they will benefit from making those investments. So I'm still okay with the TSMC. Not panicking, nothing else. So we'll probably, I think I have a put spread and a covered call on it. But that's a May expiration. If it put spreads goes in the money, I'll be able to pick some shares at a lower price. That is TSMC. Please let us know when you buy Tesla. Yeah, I don't know. My family, they are changing their plans. They say no more Tesla. I don't know for what. We'll see. All right. What were the other earnings? I think Lam Research was other earnings. I couldn't go through that. If anyone want to share on the LRCX, maybe we can pick up and see what happens to Lam Research earnings. What did this? So okay. So it's not just TSMC, obviously TSMC is impacted by overall industry. So even all other picks and shovels play in this industry have kind of a similar result. TSMC was down 15% quarter over quarter. Lam Research is down 26% quarter over quarter revenue. And same is the case on the gross margin got impacted. Operating income has got impacted by 740 bips. And of course, the EPS was down 42%. So I guess this is overall, it does mean that the overall chip requirements have come down. And we don't see the breakup of how many of them are memory chips or how many of them are the smart or are the chips that Apple uses. So I think Micron also did not have a great results. They already announced, and Micron is more into memory side of the house. So we already saw those results weren't that great, and it may be harbinger of maybe Apple didn't sell as many smartphones as what market expected it to sell. So, but we'll see. Okay, any other earnings? Otherwise, I think I have only two more topics to talk about today. One is looking at a target date retirement. So last two sessions we spent on building our portfolio, and one of the questions was, hey, on a retirement, what do you may want to hold? I think many companies by default have an option which is target date retirement, right? Especially if you have your retirement account with Fidelity, your 401k account with Fidelity, by default, your money will go into your target date funds. So they offer a turnkey solution for I wouldn't say non-sophisticated, but for those savers or retirement savers who want a hands-off approach, right? I just set it and forget it decision. I don't have to worry about or change my portfolio often. So I just want to pick and invest everything in one fund, and I don't have to look for it. And that fund will automatically balance or rebalance it, balance the constituents. So that's what made these retirement portfolio retirement funds pretty famous. When I started my 401k, when I wasn't this active in the market, I wasn't up to speed on how US market works. I use the same stuff. Because I didn't know what to invest in. I just came to US, my 401k started. I have no idea of what is SPY is. So, what do you pick? You pick whatever you give your date of birth, and then Fidelity knows what your retirement age is and suggest you that fund. I'll just invest in that fund before I became a little more active and started to manage myself. But they have their benefits, may not work well for every investor, and the reason is they do solve for a lack of investor sophistication, but they only ask one question, which is how old are you? The simplicity is also their drawback. And we'll look at some of that. But if you're looking at an example, is like this. Fidelity has tons of these. You can tell them and say, I want to retire in, say, 15 years, right? Then it is Freedom Fund 2040. And this is what their allocation right now is. And as you advance, let's say in 2025, all they will do is to reduce the allocation to stock and increase the allocation to bonds. And if you see this green circle is your bond fund. So stock going down, bonds going up. Right? Most of these retirement target date retirement funds have exposure to US bonds and international equity. That's it. Pretty simple. And if you move out more, let's say 25 years, you would see a lot more allocation to your overall stock portfolio, right? And very less to the bonds. As you move forward, bonds will increase from starting 2034, increase bonds and reduce stocks, right? But going forward, looking at the performance is not that great. Right? They have $3.27 trillion in 2021, but it was a below average performance. They in fact trailed S&P by 2.4% with a similar risk profile. So the risk is almost similar, but you are earning less. So there was discussion around what we should do if you are picking this targeted retirement fund. That means you really need to look at what are you holding in that targeted retirement fund, which defeats the whole purpose, because the whole purpose was these funds was you are not a sophisticated investor. You don't want to look what it holds. You just want one, and that should do it work for you. But since it has not, now there are questions around maybe we should find an alternative for these targeted retirement funds. So some financial advisors suggest instead of going with a default strategy, you just pick up three, own ETF, and you tune up or tune down how much percentage you want based on what your need is. So if you haven't saved enough and you want to save more into equity to get a higher kick to begin with, then you pick up these three ETFs, one track bonds, one track US stocks, one track outside. And instead of picking only 40% stocks, maybe pick up 60% for now. Just a thought. It may not work for everyone. So you may want to constitute your own targeted retirement fund. But if you don't want to do that homework, there are these targeted retirement funds which are available. Just go with it, or go with plain SPY. To me, the simplest is I'll rather go with just SPY and manage my risk. That's a quick primer. I found this interesting. Reason is this by default, a lot of your retirement money just goes into targeted retirement funds, but they haven't been doing that great when compared with the amount of risk that comes along with it, which was a surprising for me. All right, last one will be Airbnb. Before that, let me sip some water. All right. So Airbnb, and sorry, I have some handwritten notes because I'm not always in front of my laptop, but I keep my tablet with me. So if I'm listening to any, good YouTube video or a podcast, anything on a phone, I want to take a quick notes. So I did listen to one podcast wherein the hosts were talking about Airbnb, and because I hold Airbnb, I was interested in it. But the topic of discussion was, should Airbnb be a part of a core portfolio? So right now, before I heard this, I hold Airbnb, but I consider that as a part of my growth portfolio, right? So as we discussed over last 2 weeks, I have a core portfolio, then I have a growth portfolio, then I have a moonshots or the rocket ships, right? And have a decent allocations, accordingly in all the three portfolio. Right? I want to have some growth so that when the markets go crazy, 2022, not everything is down 80%, right? But if I only keep the core portfolio, then you will not be able to, pick up the next stars of the future. So you want to have a growth portfolio, but then you want to have your lottery tickets, which is a rocket ship or moonshots. So while I was listening, I also took some notes. We'll quickly go through it. I like that thought. I'll share here with you. The business is, my apologies, not the best handwriting. It is what it is. It's on tablet. but I'll read through it if it's not legible. A business in online vacation and travel rental platform. Third parties host their third party host will list their properties and we book it. If you remember, first time I opened my initial position in Airbnb was through my own personal experience. I don't know, I think it was 2021, I guess, wherein we, as a family, we wanted to go into Northern California, and I was trying to book an Airbnb, and those were like, first of all, very few were available. Most of them were booked, and the prices were through the roof. And I'm like, I'm not going to pay so much as a consumer. Those are ridiculous prices. How can they charge so much? But then my investment side of the brain was, dude, if Airbnb is able to charge so much, then I should look deeper into their business and maybe buy some shares. And I think that was my first time when I started. I bought my starter position in Airbnb, and since then been following it up and building positions in it, and now it is one of the top 10 position in the portfolio. So anyway, yeah, you don't have to get a great stock ideas. Sometimes we just have to look what we are doing, and Airbnb was one such company that came out of my when we were planning for a vacation. And of course, Airbnb takes a cut of this transaction fee. And then they also added something called travel experiences, wherein you can book experiences, not just book the house, but also go and book some sightseeing tours, etc. Overall opportunity, serviceable addressable market is 1.4 trillion. 2022 bookings were 63 billion only, which is like less than 5%. So a lot of growth still available. Why should be in the portfolio? Because it's a platform-based business model. Airbnb is the biggest hotel company without owning a single room. Like, all they do is provide a platform for this host and the renters to come together and transact, and they just take a platform fee. So from a scale perspective, they don't have to build houses. It's a very capital light business which could be scaled without needing much investment. Now, I think this is my invention, mnemonymous, which means I don't. This is not a word. I came up with. Is this mnemonymous with the short-term rentals? So if you are going to go out for a vacation, you will say, "Can you find Airbnb?" You don't say, "Can I find a short-term rental place to look to rent?" Right? Let's do Airbnb. So, but this was not the first company to offer this, and there are other companies who does it, but we just associate Airbnb with the whole concept of doing short-term rentals. Rentals are here to stay. There are other companies, like I said, have also moved into this same space. So this does validate the whole business. Management team is inspirational, especially during the COVID. Airbnb also did a layoffs. This company was written off during the COVID, right? Because no one was traveling, but the way they managed the whole COVID situation, the way they had to they manage their financial situation will be a case study in business schools, right? Branch SQ directly communicates with users and the communities. I also know, because I saw on LinkedIn, one of a person, Branch SQ also is a host, and he puts his own home on vacation, and whoever the renter is, they get to meet him in person. And of course, those people will then take a photo and put it on their LinkedIn profile or on Facebook or on Twitter saying, "Hey, I'm actually renting Brian's own home." While Brian goes out across the world and he rents the properties and other homes just to get a feel. So, and he communicates directly with the communities. So management team is strong. Valuations have now become reasonable. Stock is down 17-18% since IPO. It came IPO in the during the frenzy. So it was 2021, everything was through the moon. While the stock is down 17%, revenue is up 75%. Free cash flow is up 3,000%. Gross booking is up 67%. And profit and loss has swung from a loss of 675 million to profit of almost $2 billion. So business over the last 2 years has improved a lot. That's a summary on this. Do they have a moat? Yes, they have a huge network effect. They have 4 million hosts on their platform. As a guest, you would like to go to a platform where you have more choices. And the host would like to go where there are more guests, right? The reason why it is so difficult to challenge Facebook is the network effect. Even if I move out of Facebook to some other platform, my all friends are there on Facebook. So why would I go out? Yeah, so that's why now Facebook is what, 3 billion people on their platform. Google Plus tried it. Facebook wasn't the only one, but they were really able to get the whole network effect really nicely. Non-binary risk profile. They're not in one single country. There are almost 220 countries. They have a customers across all strata. You have a leisure travel, you have a business travel, you have properties of different levels. You want, and this is what, one day I will go and stay on those exotic properties like tree houses, submarines, staying in a boat, right? Or if you want very simple, a single family home, you can get it. You want a condo, you can get it. You want an apartment, you can get it. You want to rent a mansion for marriage, you can get that. And they have a proven track record of surviving cataclysmic events like COVID. Right? I still remember when they had to the income was almost zero because the whole travel was shut down, but they still had expenses. So they had to raise money. While the Fed funds rate were at zero, Airbnb had to pay 10% to raise money because no one in the lending business was giving any chance for Airbnb to survive. Right? So, but they managed it well. They did a layoffs, and this was the COVID layoff wave, not the recent one, but the COVID layoff. And this was I think one of the best company who have handled the layoffs very well. If I recall correctly, I only remember one thing about their layoff was, which I don't think any other companies did it, or maybe it wasn't the news, is they let all the employees keep the laptops who were laid off so that they can continue to maybe do some side gig, maybe build some online business, or at least hunt. If they have a laptop, they can still hunt for opportunities for other jobs. So they didn't take a laptops from the laid off employees. So again, it was in the news, very well handled. COVID, the impact of COVID was managed really well. But they do have a business risk, global recession. If it comes in, we are talking about recession scenarios with a high in interest rates, regulations on short-term rentals, competition increasing, and the complaints from guests around price transparency. So if I rank these risks, the biggest risk, which I say severity 1, which I see, is the complaints from guests around the prices. Right? This is one complaint which, as a customer, I also will have is, it shows me that this house is available for $250, but when I try to book it, there will be $150 for cleaning charges. There will be some other surcharges for $25. Then there will be Airbnb platform fee, and instead of $250, it shows up at $500 as a total charge. This is one complaint that we are seeing on the social media from a guest on Airbnb. So now, okay, so Asif told they already fixed it. See, I didn't book any travel in the last 1 month. Yeah. So we once stayed in a trailer, converted into a room in Eastern Sierras. Yeah. So I do have in mind, I do want to stay in some of those exotic places or those homes. Sam had awful Airbnb experience. My Airbnb experience, except one, have been all great. And the one which I had bad experience was not because of Airbnb. One of the, I think, a water pipe in that house started to leak, and there was a water which started to flood down from the kitchen ceiling. So I had to call up the host and tell Airbnb that I'm moving out of this place. We plan to stay there for 5 days, but then we moved days sooner, moved into other place. Other than that, at least my personal experience have been all good. Anyway, so this was the biggest complaint. Looks like they already addressed it pretty quickly. So now the other regulations is my second biggest risk. Third is recession. Competition is always there, but I'm not too worried about that competition right now because of the huge network effect, right? And if they have addressed these host problems, I'll continue. I'm continue to stay bullish about Airbnb. So that's Airbnb. So now looking at the business, the fact that they are now profitable, they have a huge free cash flow. I am moving it from a growth side of a portfolio to maybe a core side of portfolio. And I do want to hold it as a core wherein, where I have some of the other good companies like J&J's and Berkshire Hathaways and Microsoft's, good, profitable, nice revenue generating companies with a way longer, many more years to come. So I'm moving into my core portfolio. You can decide what you want to do, but yeah, I mean, I found this a quick, nice summary. Thought I'll share with you. Are there any Airbnb shareholders here? No one holds Airbnb? All right. Okay, Asif says he holds Airbnb. And yeah, P. Sheng shared a link. Hai Chi. Okay, oh, now we have a price to compare, which is interesting, but how would you compare? Because all these properties are kind of a different. So I think at least when it comes to booking the hotels, as a family, we don't really, the hotels are pretty standard. So if I'll book, okay, you want to book a room with 2 queen beds, then you know pretty much what you're getting.
It looks like it finds the exact same property listed on multiple sites. So you paste the link of Airbnb, and using some maybe picture magic, it finds it somewhere else, and it also finds if the provider has a direct link to their own site. So this looks pretty interesting.
Yeah, so that is great. Yeah, if it is the same property, then it makes
same
sense.
Exact one.
Yeah. So yeah, probably I'll put this to use when next time I'm going out.
If you click there, it shows you a
lot.
sample. If you click that white box, no. Okay, so that's a sample. See, it pulls the live prices, and
okay, so it's not listed here. It is verbal estimate.
And then that's the direct link. You can go straight to the owner somehow. That's pretty cool.
Quam Properties. Okay, so this is probably because the host is a property manager, and so not like they actually have their yeah, so maybe a resort owner or something. Nice. So thank you for sharing this. It's pretty
Yeah, it
good.
was Pisheng. I just I tested it, but thank you, Pisheng, for
Yeah, thanks,
that.
Pisheng.
Welcome.
Okay, how is the valuation of Airbnb? Still expensive? I think let's look at pod P of 30. So expensive from general. What's a oh, we don't get SPY here, right? But one thing which I've learned is some good companies are generally not available at cheaper prices. These are probably not super expensive. 30 is still fine when generally we look at SPY is around 15s, 20s. We just looked at some of the other tech companies, right, at the start of the session, what Meta and all that, they were all around 40s. So it is expensive when you compare it with overall market. Where was that? I think it was right up here. Yeah, 60s, 40s, 20x for Meta. But I'm okay to pay a higher valuation if the business, because business will grow into this valuation. Right? By the time the other way is by the time the valuation becomes reasonable, it could be because hey, there is not much left in the business. So I'm okay with that. It's not ridiculously high at like 80 or 100 times, which we have seen. We have seen some companies trading at 100 times PE. It's not that ridiculously high. So I'm still okay. 20, 30, 22% profit margin and paying 20 times forward earnings is okay. If you look at price to sales, it's 8.9. Not too expensive. And how much is their revenue growth? Does it show me the rev growth? Profit margins. Sales past 5 years have grown 26%. So not super high, but they talk about past 5 years, which also I guess includes the COVID. So I think post-COVID, we should look at anyway. So Airbnb is supposed to report results. I don't know when is the results. Is it this week? So we'll get more into details of what their revenue growth is. But paying 8 times, paying 9 times sales, and if it grows at 20-30% is not super expensive, I would say. But we have tools in our toolbox to reduce our the valuation, right? So we'll continue to use the tool. I don't want to wait for it to come at a reasonable valuation, because that time may never come. Who knows? All right, so that's the end of today's session. I think that's all I had. Any other things we want to talk about? We can hang around for 15-20 minutes.
Can you repeat your conclusion on Taiwan Semiconductor?
Taiwan Semiconductor, I am still bullish on a long term. First 6 months of this year from their own earnings perspective is going to be challenging, but a business should come back to normalcy in the second half of the year. So I already hold TSM in my portfolio, and I have
How would a recession affect it?
I have this put spread, and if it expires in the money, I'll probably buy some shares at a lower price. And oh, I don't have a, okay, I thought I had a call. I actually had a iron condor on it, not a naked covered call on it. So I'll still hold it. Sorry, you were asking something else?
Yeah, what would have happened if a recession hits? I lived through the 2009 recession, but I have no idea what this recession will be like.
Yeah, so at least the market thinks that the recession is going to be a mild recession. Right? But we should remember one thing, that the market generally bottoms out a few months before the recession hits in. So market is generally forward looking. So and bottoms are before recession hits in. So if we wait for recession and we think that the stocks will bottom up, will go down at recession, that may not happen. Right? Again, on the other side, I think that one analyst which is still holding its fort that the market will go down, S&P will go down to 3,200 before it goes back up and it goes higher. Because I think Mike Wilson, very well respected, but he's the only one holding his bearish outlook towards the market. So when I'm looking at this, recession hits, it's fine. We'll continue to, hedge our portfolio, continue to sell calls on TSM and reduce the cost basis. I mean, I will never be able to buy it at the absolute bottom and never be able to sell it at the high. So that's impossible to time the market. Fishing, when you close Meta call spread, did you lose money? Meta has been going up a lot. So this is the fun part, right? So I had an iron condor in Meta. I think did I put another one for May? Hold on, let me bring that up. Yes, I have one for May, right? So let's bring, not the April one is out. So let's bring in, May. Okay. So when the, again, April was, my April strike prices were 200 and 220. I think that, yeah, so that was a strike price for April. And I had probably put up that trade. Let me just go back and look at my record. So I had started that trade on 3rd of April when the stock was, sorry, not that one. When did I sell the call spread? Is opening up a short IC. Okay, over here. All right. So when I opened the April trade, iron condor, stock was at $187. It was right here, and I took a iron condor with the strike prices of 165, 155, and then 200 and 220. So which was and after that, stock has been going up and up. I rolled up my short puts over, and then eventually, stock, I don't know, I closed this on when I closed it on 20, I closed the call spread on 19th. If I'd waited till Friday, I didn't know that Friday market will go down. Probably I wouldn't have to take that much loss on option trade, but I closed it on 19th, took loss on option trade, but the long stock portfolio has benefited a lot, right? So I hold the long stocks. So those have really gone higher. Meta is up, what, 60%, close to 60% this year. That has worked beautifully for me. So overall, from a portfolio perspective, even though I lost on the option side, but because that was a hedge, I gained on the stock side. So overall, the overall portfolio, including all these losses and options, has been doing great this year. So did I lose money on Meta this year? No, I did not. It's a highly profitable ticker to hold on. But I lost on the option side because I had a call spread, but I gained a lot more on the stock side of the house. Just as last year, I gained a lot of money by selling options and the call spread, but I lost on the stock portfolio because 2022 stocks were going down. So that's what the hedging is. Anyway, so that's my answer. So now I have another one. This is for May expiration. And if the stock falls down, so I sold what I think a few stocks to buy back my call spread. I'll probably pick up those stocks at a lower price. And if not, if it continues to go higher, great. I still hold a lot of Meta stocks in my portfolio. Those will continue to do good. So that's my answer. And that's probably answer for almost all the tickers that I hold. The idea is to sell these premium to reduce the cost basis. Cool. Anything else? Otherwise, we are done for today, right on time.
Thanks.
Cool. All right, guys. Thanks, everyone. And we'll talk again next. Okay, so there's a question. If you have a stocks, why don't you sell covered calls? So I could sell iron condor or covered call, both. In some case, I have sold covered calls as well. But I do want to accumulate if it falls down. So Pishang, I mean, multiple of these strategies, right? So if I have 500 shares of a particular company, then I might sell 2 calls. In that case, I'll just sell 2 naked covered calls, right? Because if the market recovers and those stocks continue to go higher, I don't want to be, don't want to miss the growth that the stock might have. So what I started doing is either I sell a covered call on partial list of stocks, or I'll sell an iron condor or a call spread, so that if a stocks continue to go higher, fine. At some point of a time, I will, if it, let's say if someone is going and buying that company, I'll continue to enjoy a lot more upside. I won't cap my upside. It's a decision that you have to take. I look at my overall delta and say, if I have to reduce a lot more, I might either sell a covered call here, a naked covered call, or naked covered call is not a real item because it's covered by the stocks, or a call, just a call instead of a spread. Or I might do a spread here and sell a call on QQQ. So I use mostly QQQ, SPX, etc. for hedging. So I do have a lot of negative deltas over there. So I don't need too much of a negative delta here. It's a decision that you have to take. You become comfortable once you have, start dealing with these options for a few years. Then you can decide which you want to do or not. So if I had, let's say, when the year started on Meta, and Meta had started there, if I go back and look at my first trade on Meta, which is on Jan, I closed on Jan on 20th. Hold on, let me just see, when did I open the trade? First trade I did in Meta this year was on 4th of Jan. Meta was trading at $126, right? And if I had, say, done 140 or 150 covered call, stock would have been called away. Of course, I would have defended and all that, right? But I knew that the 2022, these stocks have been beaten so badly. some point of a time they will recover. So I've been either doing call spreads on all these individual tickers, and I've been selling premium on Meta, since then, since the start of Jan. So stock has gone high. Fine, I lost money on the call sides of the house, but overall the position has benefited. I didn't get what is it? I didn't get. I cannot find the exact term that you say that. I'm still in. I am still in to enjoy the gains from $126 all the way to today. It is 210. So
Yeah, but does it mean that if you didn't sell this covered call, you would have had more gains just on the stock appreciation?
yeah, but if I didn't sell the covered calls in 2022, I have had a huge lot more losses than what I had in 2022. So I always have to look at a longer term period. Longer term period, I look at this selling these options have helped me in reducing my cost basis of the shares or not. So if I look at all the shares that I hold, 80% of those shares, selling options, including covered calls or whatnot, have helped me in reducing the cost basis. 20% of those holdings were wherein stocks moved up too high or fell too low, and that didn't help me. But I'm ready to take those chances. Today in 2023, you can talk about, if I had not sold the covered calls, I would have gained a lot. Let's talk about 2022, right? So we cannot just pick one year. So I'm looking at overall, those stocks have helped me. So this year, 32 stocks, I've been able to reduce cost basis for this year out of whatever 70 stocks that I hold. Overall, 48 stocks I've been able to reduce out of the 70 stocks that I hold, 48 stocks have reduced the cost basis. So that's what it works. But if I pick one particular month or one particular year, the decision may not seem optimal, but over a long time, it has worked for me. Hope that helps.
Yeah,
that creates
thank you.
capital gain issue. Yes, if you let your covered call, if your shares get called away, that will also have your capital gains or capital loss, depending on what your price was. Selling covered call in 2020 was the worst one. Market, no one knew what Fed is going to do. So that's what I learned some lesson in 2020. And then I say, I'm going to sell, instead of selling just a call, I'll sell a call spread, so that if the markets behave like the way behave in 2020, which I thought in 2023 they would. That's why on individual stocks, I have a call spreads and not just a call. Is what if the market goes back to recovery, I don't want to be out of the market and not enjoy that growth. But overall, options have worked out for me. So that's the reason. Cool. Alrighty. Let's talk again next week. Bye, everyone.